Welcome. Subscribe to AS Foundation, India's leading academy for CA course, and hit the bell icon to get the latest updates. Thank you.
Good morning. Now, today we'll see one interesting thing. Multiple choice question on India's 19. So test yourself how much you know about India's 19. It is about employee benefits, right? So question in front of you, you'll be given 4 options and you try the best option. An entity contributes to an industrial pension plan that provides a pension arrangement for its employees. A large number of other employers also contribute to the pension plan, and the entity makes contribution in respect of each employee. These contributions are kept separate from corporate assets and are used together with any investment income to purchase annuities for retired employees. The only obligation of the entity is to pay the annual contribution. Underline, the only obligation of the entity is to pay the annual contribution. This pension scheme is a multi-employer plan and a defined contribution scheme. Multi-employer plan and a defined benefit scheme, defined contribution plan only, and defined benefit plan only. So what is your answer? Is it a multi-employer plan? Yes. A large number of other employers also contribute to the pension plan. So multi-employer plan, and this line, the only obligation of the entity is to pay the annual contribution. It's a defined. So do you think the answer is A? Yes. Sahi jawab. So tick mark A. A was the right answer. Now try this one. Which of these events will cause a change in the defined benefit obligation? Which of these events will cause a change in the defined benefit obligation? Changes in mortality rate or in the proportion of employees taking early retirement. Changes in estimated salary or benefit that will occur in the future. Changes in the estimated employee turnover. Changes in the discount rate used to calculate defined benefit and the value of the asset. This time there is a 5th option also. All of the above. So what is your answer? All of the above. So basically this question will help you to know why the defined benefit obligation changes. So these are the reasons for change in defined benefit obligation. So your answer is E, all of the above. Is it right? Right. Okay, we'll try one more. An entity has decided to improve its defined benefit pension scheme. The benefit payable will be determined by reference to 60-year service rather than 80-year service. So they have changed the scheme, modified the scheme. Earlier the benefit was based on 60-year service, 80-year service, now it is 60-year service. As a result, the defined benefit pension liability will increase by $10 million. The average remaining service lives of the employee is 10 years. How should the increase in pension liability by $10 million be treated in the financial statement? So the past service cost should be charged against retained profit. Past service cost should be charged against P&L account. Yes. The past service cost should be spread over the remaining working lives of the employee. Yes or no? No. No. The past service cost should not be recognized. Which answer do you think is right? Charged to penal account fully, immediately, or should it be deferred over 10 years? All past service cost will be recognized immediately. This standard does not distinguish between vested or unvested past service cost. So the answer is B. Okay, we'll try one more. Show your intelligence on this chapter. Which of these elements are taken into account while determining the discount rate to be used? Market yield at balance sheet date on government bond, investment or actuarial risk, specific risk associated with the entity's business, risk that future experiences may differ from actuarial assumption. Which rate is used in determining the discount rate to be used? Market yield at balance sheet date on government bond. Yes, agreed. So the answer is A. Okay, try one more. Which of these assets should be included within the valuation of plan assets? Which of these assets should be included within the valuation of plan assets? Unpaid contribution, unlisted corporate bond that are redeemable but not transferable without the entity's permission, a loan to the entity that cannot be assigned to a third party, investment in listed companies. Which of these asset will be included in the valuation of plan asset? Unpaid contribution? No. Is unlisted corporate bonds that are redeemable but not transferable without entity's permission? No. A loan to entity, loan. You can't invest in loan for plan asset. No. But you can invest in investment in shares. Investment in shares is possible. So write down D. The answer is D. One more question for you. Since you are a good student, I will give one more. An entity has decided to protect its pension obligation with an insurance policy. You can do that. You can use insurance policy for pension obligation settlement. Okay. This insurance policy permits the entity to cash in the insurance policy. Is this insurance policy a qualifying insurance policy that will be included in plan asset? Only two options. 50-50 chance. Yes, no. This line will give you the answer. The insurance policy permits the entity to cash in the insurance policy. Does this standard allow you that you can encash your insurance policy? The answer is no. The answer is no. Is it right? Once you make the contribution, then this will be returned back to the employer only when the insurance company thinks that they have got sufficient fund to pay the liability or to reimburse. But you don't have a choice to encash the insurance policy. If you have to pay your creditor, you can't go to insurance company and say, please encash my insurance policy, I have to pay my liabilities. Not allowed. So the answer is no. B. Okay. We have discussed that paragraph. An entity operates a defined benefit pension plan and changes it on 1st January 20x4. To a defined contribution plan. The defined benefit plan still relates to past service cost but not to future service. The net pension liability after the plan amendment is $70 million. and the net pension liability before the amendment was $100 million. How should the entity account for this change? So your liability has changed from $100 million to $70 million. So what is the treatment for this change? $30 million. Recognize immediately in penal account a gain of $30 million. Does not recognize a gain. Recognize a gain of $30 million over the remaining service life of the employee. And 4, the entity recognizes the gain but applies the 10% corridor approach to it. This corridor approach is no longer applicable now. So don't bother about it. We have never discussed it. Is it right? It was earlier. So option D I will eliminate for you. B also I will eliminate. Does not recognize again. This also I will eliminate. Okay, now A versus C. A, lock A. The right answer is A. This discussion is over. Thank you.